LIFO reserve, which is quite an annoying term to be explained and understand. The LIFO reserve, since it is reserve, so it is reserve of earnings. Why there's a LIFO reserve? We assume the cost of inventory keep increasing. Just like the example I show you when I discuss the difference between weighted average FIFO LIFO. If this is the case, usually there will be a LIFO reserve. Remember this example. Here, because the cost of inventory keep increasing, LIFO will result in greater cost of goods sold, but less book value of ending inventory. The reason is LIFO expense the newer inventory, which has higher cost. FIFO will expense the older inventory, which is lower cost. Since the LIFO expense newer inventory higher cost, so the cost of goods sold is higher than FIFO. But in contrast, the inventory left for LIFO will be older inventory, which is lower cost. So that's why the ending inventory is less than the ending inventory of FIFO. If we use LIFO, the cost is higher. Earnings will be lower, right? The earnings is not gone. It's just reserved in the lower cost inventory. The reason is no matter what methods we use, the total of both cost of goods sold and ending balance inventory is the same, 71,500. The lower cost inventory, which also the older inventory, will stay on the book according to this cost flow assumption, LIFO. For FIFO, the higher cost, the newer inventory will stay on the balance sheet as assets. The earnings is not gone, it is just reserved in the lower cost inventory. In the future, if the company realize this inventory, the LIFO will result in lower cost of goods sold because of this older inventory. So that's the LIFO reserve. That's basically difference between FIFO and LIFO cost flow assumptions. Again, it is based on the assumption when the cost of inventory keep increasing. Usually, the company use FIFO or weighted average for the internal reports and use LIFO for external reports. To reconcile the internal and external reports, we use the LIFO reserve or LIFO allowance as a control accounts to adjust the balance of inventory from internal to external reporting or from FIFO to LIFO. Why the company use other methods to maintain internal records? Here are the reasons. So here the company use FIFO for internal reports. That's the FIFO ending balance of inventory for the past 3 years and the cost of goods sold. And we know no matter what methods we use, it won't have impact on the sum of these two because this represents the goods available for sale. So here in 2024, the FIFO inventory was 120,000. And usually the FIFO will result in higher inventory value than the LIFO. The LIFO ending inventory was 110, FIFO was 120. The difference, 10, will be recorded as LIFO reserve. So when we convert the internal reports to external reports, basically we are going to use LIFO inventory to replace the FIFO inventory. So we will recognize extra cost of goods sold, 10,000. Well, a LIFO reserve, which will reduce the balance of inventory. from FIFO to LIFO. By using this journal entry, we recognize actual cost of goods sold because LIFO cost of goods sold is greater than the FIFO cost of goods sold. And this will reduce the book value of inventory. So we credit LIFO reserve. This is a contra accounts to the inventory. So in the balance sheet, we can see in the internal reports, the FIFO inventory was 120. After the journal entry, we less the LIFO reserve. This is credit. So the balance of LIFO inventory is 110,000. And the cost of goods sold also increased by 10,000. Remember, originally, FIFO cost of goods sold was 600,000. For LIFO cost of goods sold, it increased by 10. But the LIFO inventory decreased by 10,000. In the second year, LIFO inventory 130. FIFO was 160. Okay, so the difference will be 30,000. But since there was a 10,000 balance, we only make 20,000 adjustments. Then we can change the balance of LIFO reserve to 30,000. This is a LIFO reserve account. It was 10,000, and this determines the ending balance of this control account 30. So the adjustment is 20,000. So we debit cost of goods sold 20,000 and credit LIFO reserve 20,000. After this journal entry, originally the FIFO ending inventory was 160. We subtract 30, so that's LIFO ending inventory. And the cost of goods sold will increase just by 20,000 from 720 to 740. Last year, FIFO was 175 as reported. That's internal reports. And LIFO was calculated as 150. Now the difference is 25. Remember, by the end of 2025, the balance of LIFO reserve was 30,000. Now we just need 25,000. So we actually need to make this journal entry by reducing the LIFO reserve by 5,000. So we debit LIFO reserve and credit cost of goods sold 5,000. After this journal entry, LIFO inventory is 25,000 less than the FIFO inventory. The cost of goods sold decreased 5,000 because this journal entry we credit a cost of goods sold. Originally, the FIFO cost of goods sold was 850. LIFO cost of goods sold 845. So that's how we account for the LIFO reserve. The first line is the weighted average inventory. Less LIFO reserve, it convert to the balance of LIFO inventory. The LIFO reserve decrease, the decrease by 252. When the LIFO reserve decrease, similar to this one, we're going to debit LIFO reserve and credit cost of goods sold. So this indicates the cost of goods sold this year decreased by $252 million. Because cost of goods sold was decreased, so the profits increased. So in summary, if the company's LIFO reserve increase, the company reserve its earnings. The company report higher cost of goods sold and lower earnings. If the LIFO reserve decrease, that means these earnings are released. So you will see there's a decrease in the LIFO reserve. Again, there will be a decrease in the cost of goods sold. Finally, the earnings will be greater.